Okay, CFA Level 1 Study Session 3, which is Part 2 of the quantitative methods. We're going to start from rating 10. This study session introduces the common probability distributions used to describe the behavior of random variables, such as asset prices and returns, how to estimate measures of population with means and standard deviation based on a population sample is shown. A framework for hypothesis testing used for validating a data set hypothesis follows. Along with techniques to test a hypothesis, the section ends with coverage of technical analysis, a set of tools to use that uses asset prices, trade volumes, and other similar data to make investment decisions. Reading 10, common probability distributions, learning outcomes. You have to master, a candidate should be able to define a probability distribution and distinguish between discrete and continuous random variables and their probability functions. Describe the set of possible outcomes of a specific discrete random variable. Interpret a cumulative distribution function. Calculate and interpret probabilities for a random variable given its cumulative distribution function. Define a discrete uniform random variable, Bernoulli random variable, and binomial random variable. Calculate and interpret probabilities given the discrete uniform and the binomial distribution functions. Construct a binomial tree and describe stock price movements. Define the continuous uniform distributions and calculate and interpret probabilities given a continuous uniform distribution. Explain the key properties of a normal distribution. Distinguish between a universe and multivariance distribution, and explain the role of correlation in the multivariate normal distribution. Determine the probability that a normal distribution random variance lies inside a given interval. Define the standard normal distribution. Explain how standardize a random variable, how to standardize a variable, and calculate and interpret probabilities using the standard normal distribution. Define shortfall risk. Calculate safety first ratios and select an optimal portfolios for Roy's safety first criterion. Explain the relationship between normal and log normal distributions and why the log normal distribution is used to model asset prices. Distinguish between discretely and continuously compounded rates of return, and calculate and interpret a continuously compounded rate of return given specific holding period returns. Explain Monte Carlo simulation and describe its application and limitation. Compare Monte Carlo simulations to historical simulations. Introduction to common probability distribution. In nearly all investment decisions, we work with random variables. The return on a stock and its earnings per share are familiar examples of random variables. To make probability statements about a random variable, we need to understand its probability distribution. A probability distribution specifies the probability of the possible outcomes of a random variable. In this reading, we present important facts about 4 probability distributions and their investment uses. These 4 distributions, the uniform, the binomial, the normal, and the log normal, are used extensively in investment analysis. They are used in such basic valuation methods as the Black-Scholes or the Merton option pricing model, the binomial option pricing model, and the capital asset pricing model. With the working knowledge of the probability distributions provided in this reading, you will also be better prepared to study and use other quantitative methods such as hypothesis testing, regression analysis, and time series analysis. After discussing probability distributions, we end the reading with an introduction of Monte Carlo simulation, a computer-based tool for obtaining information on complex problems. For example, an investment analyst may want to experiment with an investment idea without actually implementing it, or she may need to price a complex option for which no simple pricing formulas exist. In these cases, many others, Monte Carlo simulations is an important resource to conduct a Monte Carlo simulation. The analyst must identify risk factors associated with the problem and specify probability distributions for them. Hence, Monte Carlo simulation is a tool that requires understanding of probability distributions. Before we discuss specific probability distributions, we define basic concepts and terms. We then illustrate the options of these concepts through the simple distribution, the normal or the uniform distribution. That done, we address probability distributions that have more applications in investment work, but also greater complexity. 10.2. Discrete random variables. A random variable is a quantity whose future outcomes is uncertain. Two basic types of random variables are discrete variables and continuous variables. A discrete variable can take on at most a countable number of positive values. For example, so they're positive integers. A discrete variable x can take limited numbers of outcomes of x1, x2 all the way to xn, where n is the possible outcomes, or a discrete random variable y can take on a limited numbers of outcomes y1, y2 all the way to without end. Because we can count all the possible outcomes of x and y, even if we go on forever in the case of y, both x and y satisfies the definition of a discrete random variable. By contrast, we cannot count the outcomes of continuous random variables. We cannot describe the possible outcomes of a continuous random variable z with the list z1, z2, because the outcome z1 plus z2 divided by 2 not in the list would always be possible. Rate of returns is an example of a continuous random variable. In working with random variable, we need to understand its possible outcomes. For example, a majority of the stock traded on the New Zealand Stock Exchange are quoted in ticks of 1 cent, New Zealand dollar. Quoted stock prices is thus a discrete random variable with possible values of 0, 0.01, 0.02, ... all the way to infinity. But we can also model stock prices as a continuous random variable, as a log normal random variable. To look ahead in many applications, we have a choice between using a discrete or continuous distribution. We are usually guided by which distribution is most efficient for the task we face. This opportunity for choice is not surprising, as many discrete distributions can be approximated with a continuous distribution and vice versa. In most practical cases, a probability distribution is only a mathematical idealization or appropriate model for the relative frequency of a random variable's possible outcomes. Okay. So example 1, the distribution of bond price. Let's say you are researching a probability model for bond price, and you begin by thinking about the characteristics of bonds that affect price. What are the lowest and the highest possible values for bond price? Why? What are some other characteristics of bonds that may affect the distribution of bond prices? The lowest possible value for bond price is 0 when the bond is worthless. Identifying the highest possible value for bond prices is more challenging. The promised payments of a coupon bond are the coupons or the interest payments plus the face amount, which is the principal. The price of a bond is the present discounted value of these promised payments because investors require a return on the investment. 0% is the lower limit of the discrete rate that investors would use to discount a bond's promised payout. At a discount rate of 0%, the price of a bond is the sum of the face value is 1,000, and two $40 coupons remains. The interval 0 to 0 and 1,080 captures all possible values of the bond's price. The upper limit decreases through time as the number of remaining payments decreases. Other characteristics of a bond also affects its price distribution. Pool to par value is one such characteristic. As the maturity date approaches, the standard deviation of bond prices tend to grow smaller as bond prices converges on par value. Embedded options also affect bond price. For example, with bonds that are currently callable, the issuer may retire its bond at its specified premium above par. This option of the issuer cuts off parts of the bond's upside. Modeling bond price distribution is a challenging problem. Every random variable is associated with a probability distribution that describes the variable completely. We can view a probability distribution in two ways. The basic view of is the probability function, which specifies the probability that a random variable takes on a specific value, or the probability of x equaling x is the probability of the random variable x takes on the value of x. Note that capital X represents the random variable and lowercase x represents a specific value that the random variable may take. For a discrete random variable, the shorthand notion for the probability function is probability of x, or the probability of a specific value of a random variable may take is equal to the probability of x equaling x. The continuous random variable, for continuous random variables, the probability function is denoted as f of x and called probability density function, or the PDF, or just density. A probability function has two properties which we state without loss of generality using the notion for a discrete random variable. Probability must be between 0 and 1. It could also equal 0 or equal 1 because probability is a number between 0 and 1. The sum of a probability P of x over all values of x equals 1 if we add up all the probabilities of so all the possible outcomes added together will equal 1. Okay. We are often interested in finding the probability of a range of outcomes rather than a specific outcome. In this case, we take a second view of probability distribution, the cumulative distribution function, or the CDF. The CDF, or the cumulative distribution function, or distribution function for short, gives the probability of a random variable x is less than or equal to a particular value of x. A probability of x when it is lesser than x, both discrete and continuous random variables. The shorthand notion for f of x is equal to probability of x lesser or equal to x. How does the cumulative distribution function relate to the probability function? The word cumulative tells the story. To find f of x, we sum up or accumulate values of the probability function for all outcomes less or equal to x. The function of the CDF is parallel to concepts and market returns. Next, we illustrate these concepts with examples and show how we use discrete and continuous distributions. We start with the simplest distribution, the discrete uniform. The discrete uniform distribution. The simplest of all probability distribution is the discrete uniform distribution. Suppose that the possible outcomes of integers, whole numbers, 1 to 8 inclusive, and the probability that the random variable takes on any of these possible values is the same for all outcomes. That is, it is uniform. With each outcomes, the probability of x occurring is of one specific outcome occurring, 1, 2, 3, 4, 5, 6, 7, or 8, it will be 1 out of 8, which is 0.125 for all values of x, which is 1 to 8. The statement just made is a complete description of its discrete uniform random variable. The distribution has a finite number of specific outcomes, and each outcome is equally likely. Table 1 summarizes the two views of the random variable, the probability function and the cumulative distribution function. Table 1 with the probability function and cumulative distribution function for a discrete uniform random variable. Probability function is 1. Okay, so the probability is all the same. Okay, and cumulative is when you add. For example, what happens at 2 is you add 1 and 2 together. The probability of 1 and 2 together, and the probability of 7 is is 7 factorial. When you add 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, or 1, 2, 3, 4, 5, 6, 7 all together, which you get this. And once again, if 8 represents the universal set, so you add it together 8 times, and of course you get 1, because we divided this figure, or 1, or 100% out of 8. So obviously it makes sense that if we add all 8 together, we'll get 1. We could use table 1 to find the probabilities. The probability x is less than 7 or equal to 7, or the probability of 4 is between, the probability of x is between 4 and 6. And I would suppose this is discrete, right? So if it's discrete, then it will just take 5 in this case. Or the probability of x is between 4 and 6. The following example illustrates how to use CDF to find a probability that a random variable will fall in any interval for any random variable, not only the uniform. The probability of x is less than or equal to 7, which is which looks like that. In the next to last entry of the third column, which is which is 87.5%. To find probability between 4 and 6, we need to find the sum of 3 probabilities, probability 4, 5, and 6. We could find this sum in 2 ways. We could add probability of 4, 5, and 6 from the second column, or we could calculate the probability as the difference between 2 values of the cumulative distribution function. So we could do that. So we can calculate the second probability of f of 6 minus f of 3, which is given by 3 divided by 8. The third probability between 4 and 6. So this is quite intuitive, okay? There isn't much to say about here. Okay. Binomial distributions, 2.2 binomial distributions. In many investment contexts, we view In many investment contexts, we view a result as either a success or a failure, or as a binary, which is twofold. Okay. In some other ways, we can make probability statements about a record of success and failure, or about anything with binary outcomes. We often use the binomial distribution. What is a good model for good model for how a stock price moves through time? Different models are appropriate for different uses. Kotz, Rost, and Rubinstein developed an option pricing model based on binary moves, price up or price down for the asset underlying the opinion. Their binomial option pricing model was down for the asset underlying the opinion. Their binomial option pricing model was the first of the class of related option pricing models that have played an important role in the development of derivatives industry. The fact alone would be sufficient reason for studying the binomial distribution, but the binomial distribution has uses in decision-making as well. The building block of the binomial distribution is the Bernoulli random variable, such named after the Swiss probabilist Jacob Bernoulli. Suppose we have a trial, an event that may repeat, that produces 1 or 2 outcomes. Such a trial is a Bernoulli trial. If we let y equal 1, when the outcome is success, and y equals 0 when the outcome is a failure, then the probability function of binomial random variables y is probability of 1, which is success, is equal to the probability of p. The probability of failure, or 0, is equal to 1 minus p, the universal set minus p, because you can only have 2 results, as the name binomial suggests, where p is the probability of trials in a success. Our next example is the very first step on the road of understanding how binomial option pricing models. 1 period stock price movement as a Bernoulli random variable. Suppose we describe stock price movements in the following way. Stock price today is S. Next period stock price can move up or down. The probability of an up move is P, and the probability of a down move is 1 minus P, because it can only be up or down. It can't be sideways in this example. Just the stock price is a Bernoulli random variable with the probability of success and up move equal to P, and when the stock market moves up, ending prices of US with U equal to 1 plus the rate of return in the stock if the stock moves up. For example, if the stock earns 0.01 or 1% on return on the move, U equals 1.01. When the stock moves down, ending price of DS with D equals to 1 plus the rate of return if the stock moves down. For example, if the stock earns negative 0.01 or negative 1% on a down move, then figure 1 shows a diagram of the stock dynamics. Okay. So probability of moving up is P. The probability of moving it down, or the stock price decreasing, is everything else besides P. So it's 1 minus P. So there's only 2 outcomes. That's why we call it binomial. We will continue with the above example later. In the model of stock price movement is in example 2. Success and failure at a given trial relates to up moves and down moves respectively. In the following example, success is a profitable trade and failure is an unprofitable trade. Example 3, a trading desk evaluation book brokers. You work in equities reading at an institutional money manager that regularly trades with a number of block brokers. Blocks are orders to sell or buy that are too large for liquidity ordinary available in dealers' network or stock exchanges. Your firm has known interest in certain kinds of stock. Block brokers calls your trading desk when they want to sell blocks of stocks that they think your firm may be interested in buying. You know that these transactions have a definite risk. For example, the broker's client or seller of the shares has unfavorable information on the stock, or if the total amount he is selling through all channels is not truthfully communicated to you, you may see a limited loss on the trade. For time to time, your firm audits the performance of block brokers. Your firm calculates the past trades, market risk adjusted dollar returns on the stock purchase from the block brokers. On the basis you clarify each trade as profitable or unprofitable or profitable. You have summarized the performance of the brokers in a spreadsheet expected in excerpt in table 2, November 2014. The broker's name of code is this. So there are 3 profitable trades and 9 losing trades for this stock. For BB002, we have 5 profitable trades and 3 losing trades. View each trade as a Bernoulli trade. Trial, calculate the percentage of profitable trades with the 2 blocks brokers for November 2014. These are estimates of P, the underlying probability of success or the profitable trades with each broker. Your firm has logged 3 plus 6 equals 12 trades for total rows, and block brokers BB1 because 3 of the 12 trades were profitable. The percentage of profitability was 25%. Well, with broker BB2, the percentage of profitability was 62.5%. As a trade is a Bernoulli trade, and the above calculations provide estimates of underlying probability of a profitable trade success with the 2 brokers. For brokers BB0OI, your estimate of P is equal to 0.25. For BB002, your estimate is 0.6025. In N, Bernoulli trials, we have 0 to N successes. If the outcomes of an individual trial is random, the total number of successes in N trials is also random. A binomial random variable X is defined as the number of successes in N binomial Bernoulli trials. A binomial random variable is the sum of the binomial random variables, which looks like this, where Y1 is the outcome of the IF trial, 1 is the success, 0 is the failure. We know that a Bernoulli random variable is defined by the parameter p, the number of trials. N is the second parameter of a binomial variable. The binomial distribution makes the assumption that the probability of p success is constant for all trials. I mean, that's kind of a prerequisite that you have to have, or else if each trial is different, you're not going to be able to calculate any meaningful relationship. The trials are independent, and the second assumption has great simplifying force. If individual trials were correlated, calculating the probability of a given number of success in n trials would be much more complicated. Under the above two examples, a binomial random variable is completely described by two parameters, the n and the p. We write n. We write x is distributed with the binomial distribution of n and p, so that, which is read as x is binomial distribution with parameters of n and p. We could see that Bernoulli random variable is a binomial random variable with n equals 1, where y is distributed binomially to 1 and p. Now we can find the general expression for the probability of binomial random variables shows x successes in n trials. We could think in terms of a model of stock price dynamics that can be generalized to allow any possible stock price movements if the period that are made extremely small. Each period is a Bernoulli trial with probability p. The stock price moves up, the probability p 1 minus p, the price moves down. A success is an up move, and x is a number of up moves or successes in n periods or trials. Any sequence of n periods that shows exactly x up moves shows n minus x down moves. We have many different ways to order the up moves and down moves to get a total of x x up moves. But given independent trials, we need to multiply the probability by the results in counting from the reading of probability concepts. So these are just using the formulas. Okay. Okay, so these are the binomial or discrete random variables. So I hope to see you guys in the next reading, where we'll be talking about unit reading 10 part 3 about continuous random variables. I hope to see you guys there, and take it easy. Goodbye. Continued CFA Level 1 reading 10, Part 3, Continuous Random Variables. In the previous section, we considered discrete random variables, i.e. random variables whose set of possible outcomes is countable. In contrast, the possibility outcomes of continuous random variables are never countable. If 1.25 is one possible value of a continuous random variable, for example, we cannot name the next higher or lower possible value. Technically, the range of possible outcomes of the continuous random variable is the real line. All real numbers between negative infinity and positive infinity are some subset of the real line. In this section, we focus on two most important continuous distributions in investment work, the normal and log normal, as we did with discrete distributions. We introduced the topic, drew the uniform distribution. 3.1, continuous uniform distributions. The continuous uniform distribution is the simplest continuous probability distribution. The uniform distribution has two main uses as a basis for techniques for generating random numbers. The uniform distribution plays a role in Monte Carlo simulations as the possibility distribution that describes equally likely outcomes. The uniform distribution is an appropriate probability model to represent a particular kind of uncertainty in belief in which all outcomes appear equally likely. The PDF for a uniform random variable looks like this. For example, A equals 1, B equals 8, f of x equals 1 out of 8, or 0.125. We graph the density in figure 3. So this is what it looks like. The graph of the density function plots as a horizontal line with the value of 0.125. What is the probability that a uniform random variable with limits of a equals 0, b equals 8 is less than or equal to 3, or f of 3 is equal p less or equal to 0? When we were working with the discrete uniform random variable with possible outcomes 1, 2 to 8, we summed individual probabilities. P1 plus P2 plus P3 equals 0.375. In contrast, the probability that a continuous random variable or any continuous random variable, assuming any given value, is 0. To illustrate the point, consider the narrow intervals of 2.510 to 2.511. Because the interval holds an infinity of possible values, the sum of the probabilities of values in the interval alone would be infinite if each individual value in it had a positive probability. To find the probability f of 3, we find the area under the curve, graphing the PDF, or between 0 to 3 on the x-axis. In calculus, this operation is called integrating the probability function of x from 0 to 3. The area under the curve is a rectangle with base of 3 minus 0 equals 3. The height of 1 out of 8. The area of the rectangle equals the base times the height, or 3 multiplied by 1/8. So f of 3 equals 0.375. The interval form of 0 to 3 is 3/8 of the total length between the limits of 0 and 8, and f of 3 is 3/8 of the total probability of 1. The middle line of this expression for the CDF captures this relationship. For our problem, f of x equals 0. For values x less or equal to 0, f of x is this. We could graph the CDF in figure 4, like this. So CDF is when you add up the previous values as well. The mathematical operations that correspond to finding the area under the curve of PDF f of x from a to b is the integer of f of x is equal from a to b. So we use calculus where of a dx symbol of summing over small changes of dx, and the limits of the integration a and b can be any real number, or negative 1 infinity to positive infinity. All probabilities of continuous random variables can be computed using equation 2 for the uniform distribution. Example considered above, f of 7 is equation 2 with lower limits a equals 0, the upper limits b equals 7. The integral corresponding to the CDF of a uniform distribution reduces to the 3-line expression given previously. To evaluate equation 2 for nearly all other continuous distributions, including the normal and log normal, we rely on spreadsheet functions, computer programs, or tables of values to calculate probabilities. Those tools use various numerical methods to evaluate the integer in equation 2. Recall the probability of a continuous random variable equating any fixed point is 0. This fact has an important consequence for working with the cumulative distribution function of a continuous random variable. For any continuous random variable x, probability of x is between a and b. Because the probability of the endpoints a and b are 0, the discrete random variables for discrete random variables, these relations are equally are not true because probability accumulates at points. Example 7, probability that a lending facility covenant is breached. You are evaluating the bonds of a below investment grade borrower at a low point in the business cycle. You have many factors to consider, including the terms of the company's bank lending facilities, the contract The contract creating a bank lending facility such as unsecured line of credit typically has clauses known as covenants. A covenant places restrictions on what the borrower can do. The company will be in breach of a covenant if the lending facility of the interest coverage ratio, or the EBITDA divided by interest calculated on EBITDA over the 4 trailing quarters falls below 2. EBITDA is earnings before interest, taxes, depreciation, and amortization. Compliance with the covenant will be checked at the end and ameliorated. Compliance with the covenant will be checked at the end of the current quarter. If the covenant is breached, the bank can demand immediate repayment of all borrowings on the facility. The action will probably trigger a liquidity crisis for the company. With a huge degree of confidence, you forecast interest changes of 25 million. You estimate that EBITDA runs from 40 million on the low end to 60 million on the high end. Address 2 questions: treating projected interest charges on a constant if the outcomes of EBITDA are equally likely. What is the probability that EBITDA / interest will fall below 2, breaching the covenant? Estimate the mean and standard deviation of this for a continuous uniform random variable. The mean is given by mu equal to a plus b divided by 2, and the variance is given by the standard deviation squared, which is equal to b minus a squared divided by 12. Solution to 1. This is a continuous uniform random variable. Because all outcomes are equally likely, the ratio can take on values between 1.6 or 40 million divided by 25 million on the low end, and 24 or 12.4, which is equal to 60 divided by 24 million on the high end. The range of possible values is 2.4 minus 1.6, which equals 0.8. What fractions of the possible values fall below 2? The level of the trigger defaults. The distance between 2 and 1.6 is 0.4. The value of 0.4 is 1/2 of the total length of 0.8 or 0.5. So the probability that the covenant will be breached is 50%. Solution to 2. In solution 1, we find that the lower limit of EBITDA divided by interest is 1.6. The lower limit is A. We found that the upper limit is 2.4. The upper limit is B using the formula given above. Mu equals 2.0. The variance of the interest coverage ratio is therefore this. The standard deviation is the positive square root of the variance. 0.230940 equals this to the square root. The standard deviation is not particularly useful as a risk measure for a uniform distribution. However, the probability that lies within various standard deviation bands around the mean is sensitive to different specifications of the upper and lower limits. Although Chebyshev's inequality is always satisfied, here, one standard deviation interval around a mean of 2.01 runs from 1.769 to 2.231 and captures 57.8% of the probability. A 2 standard deviation interval runs from 0.532 to 2.462, which extends past both the lower and upper limits of the random variable. The normal distribution may be the most extensive used probability distribution in quantitative work. It plays key roles in modeling portfolio theory, and is a number of risk management technologies. Because it has so many uses, the normal distribution must be thoroughly understood by investment professionals. The role of the normal distribution is statistical inference, and regression analysis is vastly extended by a crucial result known as the central limit theorem. The central limit theorem states that the sum or the means
and the means of a large number of independent random variables is approximately normally distributed. The French mathematician Abraham de Moivre introduced the normal distribution in 1733 and developed a version of the central limit theorem. As figure 5 shows, the normal distribution is a symmetrical and bell-shaped all real numbers between negative infinity to positive infinity. The trials of the bell curve extend without limit to left and to right. Defining characteristics of the normal distribution are as follows. The normal distribution is completely described by two parameters. Its means are the mu and its variance, the standard deviation squared. We indicate this as the x is distributed normally with mu and standard deviation squared, which is variance, read as x follows a normal distribution with mu and variance standard deviation squared. We can also define a normal distribution in terms of the means and the standard deviation. Mu is often convenient because standard deviation is often convenient. This is often convenient because standard deviation is measured in the same unit as x and mu. And a consequence, we can answer any probability questions about a normal random variable if we know its mean and variance or standard deviation. The normal distribution has a skewness of 0. It is symmetric. The normal distribution has a kurtosis of 3. Its excess kurtosis or kurtosis minus 3 equals 0. As a consequence of symmetry, the mean, median, mode are all equal of a random variable. A linear combination of two or more normal random variables is most normally distributed. These bullet points concerns a single variable or unvariate normal distribution. The distribution of one normal random variable, the univariate distribution describes a single random variable. Or multivariate distribution specifies the probability for a group of related random variables. You will encounter the multivariate normal distribution in investment works and reading and should know the following about it. When you have a group of assets, we can model the distribution of returns on each asset individually, or the distribution of returns on the asset of a group as a group. Means that we take account of all the statistical interrelationships among the return series. One model that has often been used for security returns is the multivariate normal distribution. A multivariate normal distribution for the returns on any stock is completely defined by 3 lists of parameters. The list of the mean returns on the individual securities and means in total, the list of security variance of the return and variance in total, and the list of distinct pairwise returns correlation and multiplied by n-1 divided by 2 distinct correlations in total. The need to specify correlation is a distinguishing feature of the multivariate normal distribution in contrast to the normate normal distribution. The statement assume returns assume returns are normally distributed is sometimes used to mean a joint normal distribution for a portfolio of 30 securities. For example, portfolio returns is a weighted average of the returns on the 330 securities. A weighted average is a linear combination. Thus, portfolio returns is normally distributed if the individual security returns are joint or normally distributed. And to review, in order to specify the normal distribution for portfolio returns, we need the means, variance, and the distinct pairwise correlations of the component securities. With these concepts in mind, we can return to the normal distribution for one random variable. The curves graph in figures 5 are the normal density function. The two density graphed in figure 5 correspond to a mean of mu equals 0 and standard deviation of mu equals 1 and 2. The normal density with mu equals 0 and standard deviation equals 1 is called the standard normal distribution or unit normal distribution. Plotting two normal distributions with the same mean and different standard deviations all helps us appreciate why standard deviation is a good measure of dispersion. For the normal distribution, observations are much more concentrated around the mean. For the normal distribution with standard deviation equals 1, the normal distribution with a standard deviation equals 2. Although not literally accurate, the normal distribution can be considered an approximate model for returns. Nearly all the probability of a normal random variable is constrained within 3 standard deviations of the means for realistic values of means return. Whether the approximation is useful is a closer fit of the quarterly, yearly, So here's just the normal distribution, percentage breakdown for each segment. Approximate 50% of all observations falls in the category of standard deviation 2/3, 68 within 1 standard deviation, 95 within 2 standard deviations, and 99% of all observed factors or data within 3 standard deviations. That's it to know right here. Okay. In general, we do not observe the population mean or population standard deviation of a distribution. So we need to estimate them. We estimate the population mean or mu using the sample mean x bar, also sometimes denoted as infinity with a hat on it. They estimate the population standard deviation or the standard deviation using the sample standard deviation s, sometimes denoted as the standard deviation with a hat on it. There are as many different normal distributions as there are choices for mu and variance. We can answer all the above questions in terms of any normal distribution spreadsheets, or for examples, have functions of the normal CDF. Standard normal probabilities can also be computed with spreadsheets, statistical and econometric software, and programming languages. Tables of the cumulative distribution function for the standard normal random variable are on the back of the book. Table 5 shows an excerpt of the tables, and of X is the conventional notion for the CDF of a standardized normal variable. So these shows the probability for each. To find the probability that the standard normal variable is less than or equal to 0.24, for example, locate the rows that contain 0.2. Look at column 0.04 and find the entry 0.5948 thus that is 59.48%. The following are some of the most frequently referenced values in the standard normal table. So that's what it looks like. This is just population distribution. Okay, I'm gonna continue the reading tomorrow. Kind of really tired today, so I'm gonna just end today's reading right here.
Continued reading. Applications of normal distribution. Modern portfolio theory, MPT, makes wide use of the idea of the value of investment opportunities can be meaningfully measured in terms of means returns or invariance of returns. In economic theory, mean variance analysis holds exactly when investors are risk adverse when they choose investments so as to minimize expected utility or satisfaction, and when either 1, returns are normally distributed, or 2, investors have quadratic unity functions. Mean variance analysis can still be useful, however, that is, it can hold approximately when either assumption 1 or 2 is violated, because practitioners prefer to work with observables such as returns. The proposition that returns are at least approximately normally distributed has played a key role in much of MPT. Modern portfolio theory. Mean variance analysis generally considers risk symmetry in the sense that standard deviation captures variability both above and below the means. An alternative approach evaluates only downside risk. We discuss one such approach, safety first rules, as it provides excellent illustrations of the application of normal distribution theory in practical investment problems. Safety first rules focus on shortfalls risk and risks that portfolio values will fall below some minimum acceptable level over the time horizon. The risk that the asset in a defined benefit plan will fall below planned liabilities is an example of a shortfall risk. Suppose an investor views any return below a level of RL as unacceptable. Roy's safety first criterion states that the optimal portfolio minimizes the probability of the portfolio return RP falls below the threshold of RL. In symbols, the investor's objective is to choose a portfolio that minimizes RP to be lesser than RL. When portfolio returns are normally distributed, we can calculate RP lesser than RL using number of standard deviation that RL lies between the expected portfolio returns of expected value of RP. The portfolio for which our expected RP or RP subtracted by RL is the largest relative to standard deviation minimizes P when RP is lesser than RL. Therefore, if returns are normally distributed, the safety first optimal portfolio maximizes the safety first ratio, or the S of R SF ratio, which looks like this. The expected value of RP subtracted by RL divided by the standard deviation P. The quantity of the safety first ratio is the distance from the mean's return to the shortfall level. Dividing this distance by standard deviation P gives the distance in units of standard deviation. There are 2 steps in choosing among portfolios using Roy's criterion, assuming normality. Calculate each portfolio's SFR or the safety first ratio. Choose the portfolio with the highest safety first ratio. For a portfolio with a given safety first ratio, the probability that its returns would be less than RL is n multiplied by negative the safety first ratio, and the safety first optimal portfolio has the lowest such probability. For example, suppose an investor's threshold return of RL is 2%. He is presented with 2 portfolios. Portfolio 1 has an expected return of 12% with a standard deviation of 15%. Portfolio 2 has an expected return of 14% with a standard deviation of 16%. The safety first ratio, or 0.667, or calculated by 12 minus 2 divided by 10, and 0.75 for portfolio 1 and 2 respectively. For the superior portfolio 2, the probability that portfolio returns will be less than 2% is around 23%, assuming the portfolio returns the normal distributed. You may have noticed the similarity of safety first ratio and the Sharpe ratio. If we substitute the risk-free rate, or RF, with the critical level RL, the safety first ratio becomes the Sharpe ratio. The safety first approach provides a new perspective on the Sharpe ratio. When we evaluate portfolios using the Sharpe ratio, the portfolio with the highest Sharpe ratio is one that minimizes the probability that portfolio returns will be less than the risk-free rate given a normality assumption. Example 9, safety first optimal portfolio for a client. You are researching asset allocations for a client in Canada with 800,000 Canadian dollars portfolio. Although her investment objectives is long-term growth, At the end of a year, she may want to liquidate 30,000 of the portfolio fund to educational expenses. If the need arises, she will like to be able to take out 30,000 without invading the initial capital of 800,000. Table 6 shows 3 alternative allocations, A, B, and C, with expected annual returns of 25, 11, and 14, with the standard deviations of 27, 8, and 20. So let's see what the questions are going to be. Address these questions from assume normality for parts 2 and 3. Given a client's desire not to invade the $800,000 principal, what is the shortfall level for the return of L? Use the shortfall level to answer part 2 according to the safety first criterion. Which of the 3 allocations is best? Which of the probability of the return on a safety first optimal portfolio will be less than the shortfall level? Because 30,000 divided by 800,000 is 3.75%. For any return less than 3.75%, the client will need to invade principal if she takes out 30,000. So RL equals 3.75%. Solution to 2, to decide which of the 3 allocations is a safety first optimal, select the alternative with the highest level, the highest ratio, the expected probability of RP subtracted by RL divided by the standard deviation of P. Allocation of A is this. Allocation of B is this. Allocation of C is this. Allocation of B with the largest ratio of 0.90625 is best alternative according to the safety first criterion. Solution to 3, to answer this question, note that probability of RB is lesser than 3.75 equals n of negative 0.90625. We could round this to 91 for use with tables of standard normal CDF. First, we calculate this is about the n of negative 0.91 is around 18.1% using the spreadsheet functions of the standard normal CDF on 0.90625. Without rounding up, we get 18.25% to 4% or above 18.2%. The safety first optimal portfolio has a roughly 18% chance of not meeting 3.75% return threshold. Several points are worth noting. First, if we input slightly differently, if we input even slightly differently, if the inputs were even slightly different, there we go, we could get a different ranking. For example, if the mean return on B was 10 rather than 11%, A would be superior to B. Second, if meeting a 3.75 return threshold was a necessity rather than a wish, C 830,000 in 1 year could be modeled as a liability. Fixed income strategies such as cash flow matching could be used to offset or immunize $830,000 quasi liability. Roy's safety first rule was the earliest approach to addressing shortfall risk. The standard mean variance portfolio selection process can accommodate a shortfall risk constraint. In many investment contexts, besides Roy's safety first criterion, we use the normal distribution to estimate a probability. For example, Klob, Gay, and Hunter 1985 develop an expression based on a standard normal distribution for the probability that a futures trader will exhaust his liquidity because of losses in a future contract, another arena in which the normal distribution plays an important role in financial risk management. Financial institutions such as investment banks, security dealers, and commercial banks have formal systems to measure and control financial risks at various levels, from trading positions to the overall risk for the firm. Two mainstays in managing financial risks are values at risk, or VAR, values at risk, the stress testing / scenario analysis, stress testing / analysis, scenario analysis, a complement to VAR, refers to a set of techniques for estimating losses in extremely unfavorable combinations of events or scenarios. Value at risk, or VAR, is a money measures of the minimum value of losses expected over a specific time period, for example, a day, a quarter, or a year, at a given level of probability, often 0.05 or 0.01. Suppose we specify a 1 day time horizon and a level of probability of 0.05, which would be called 95% 1 day VAR. If this VAR equaled 5 million for a portfolio, there would be a 0.05 probability that the portfolio would lose 5 million euros or more in a single day, assuming our assumptions were correct. One of the basic approaches to estimating VAR, the variance, convergence, or analytical methods, assuming that returns follow a normal distributions. For more information on VAR, see Chance and Brooks, 2016. The log normal distribution, closely related to the normal distribution. The log normal distribution is widely used to model probability distributions of shares and other asset prices. For example, the log normal appeals to Black-Scholes Merton opinion pricing model. The Black-Scholes Merton model assumes that the price of an asset underlying the options is log normally distributed. A random variable y follows a log normal distribution if its natural logarithm lny is normally distributed. The reverse is also true. If the natural logarithm of random variables x, ln y is normally distributed, the y follows a log normal distribution. If you think of a term log normal as log is normal, you have no trouble remembering this relationship. Yeah, that's a funny way to think of it, I guess. So just ln it, and if it's a straight line, then you know it's log normal. The two most noteworthy observations about log normal distributions are that it is bounded by 0, and the skewness on the right. It has a long right tail. Note these two properties in the graph of the PDFs of two log normal distributions in Figure 7. Asset prices are bounded from below by 0. In practice, the log normal distribution has been found to be usefully accurate description of the distribution of prices for many financial assets. On the other hand, the normal distribution is often a good approximation for returns. For this reason, both distributions are very important for financial professionals. So it's skewed to the right. You can see we have a longer tail at the right-hand side. So that's what it was talking about. Two log normal distributions. Okay. Like the normal distribution, the log normal distribution is completely described by two parameters. Unlike the other distributions, we can consider a log normal distribution is defined in terms of parameters of a different distribution. The two parameters of a log normal distribution are the mean and standard deviation, or variance, of its associated normal distribution. The mean and variance of ln y given y is log normal. Remember, we must keep track of two sets of means and standard deviation or variance. The mean and standard deviation or variance of the associated normal distribution. These are the parameters, and the mean and standard deviation or variance of the log normal variable itself. The expression for the mean and variance of log normal variables itself are challenging. Suppose a normal random variable x has expected value mu and variance of standard deviation squared. Define y as expected value of x. Remember that the operation indicates that the expected value of x, or e of x, is the opposite operation for taking logs. Because ln y is equal to the ln of expected value of x. X is normal. We assume x is normal. Y is log normal when what is the expected value of y with the expected value of x. A guess might be that the expected value of y is the expected value of the mu, which is the mean. The expected value is actually expected value of mu plus 0.5 standard deviation squared or 0.5 variances, which is larger than the expected value of mu by a factor of expected value of 0.5 variance is greater than 1. To get some insight into this concept, think of what happens if we increase the variance. The distribution spreads out, right? If we increase the variance, distance to the mu, then the distribution spreads out. It could spread upwards, but it cannot spread downwards past 0. As a result, the center of its distribution is pushed to the right. The distribution mean increases. The expression of the mean, an expression for the mean and variance of the log normal variable are summarized below. The mu and the variance are the mean and variance of the associated normal distribution. Refer to these expressions as needed rather than memorizing them. So the mean, or the mu L, of the log normal random variable is equal to the expected value of mu plus 0.5 variances. Or variances, or the variance of L, is the log normal random variable of expected value of 2 mu plus variance multiplied by expected value of variance subtracted by 1. We now explore the relationship between the distribution of stock return and stock price. In the following, we show that if a stock's continuously compounded return is normally distributed, the future stock price is necessarily log normally distributed. Furthermore, we show that stock price may be well described by the log normal distribution even when continuously compounded. Returns do not follow a normal distribution. These results provide the theoretical foundation for using the log normal distribution to model prices. To outline the presentation that follows, we first show that the stock price at some future time, or t, or st, equals the current stock price of S0 multiplied by e raised to the power of R0 t. The continuously compounded return of from 0 to t, this relationship is expressed as S of t, or st, is given as this. We should then show that we can write ROT as the sum of the short-term continuously compounded return, and that if these short period returns are normally distributed, then R0t is normally distributed given certain assumptions, or approximately normally distributed. Not making those assumptions, as st is proportional to the log of the normal random variable, st is log normal. To supply a framework for our discussion, suppose we have a series of equally spaced observations on stock prices, S1, S2, all the way to ST, current stock prices. S0 is a known quantity, and so is non-random. The future prices, such as S1, however, are random variables. The price relatives of S1 divided by S0 is an ending price, S1 over the beginning price S0, so is equal 1 plus the holding period return of the stock, which is this. An important concept in the continuously compounded return associated with a holding period return, such as R01, is the continuously compounded return associated with a holding period in a naturally logarithm of 1 plus the holding period return, or equivalently, the natural logarithm of the ending price over the beginning price. The price relative, for example, if we observe a 1 week holding period return of 0.04, the equivalent continuously compounded return called the 1 week continuously compounded return is ln of 0.04, which is equal to this. €1 invested for a week at this rate, continuously compounded, will give €1.01, equivalent to 4% 1 week holding period return. The continuously compounded return for t to t plus 1 is this. For our example of R or 0 and 1, ln of S1 divided by Sn equals ln of 1 plus R of O and 1, so that's what it looks like. Thus, 13.98% is the continuously compounded return from t of 0 to t of 1. The continuously compounded return is smaller than the associated holding period return. If our investment horizon extends from t of 0 to t of t equals t, then the continuously compounded return to t is this. Okay. So yeah, independently and identically distributed continuously compounded returns play a role in many option pricing models, as mentioned earlier. An estimate of volatility is crucial for using option pricing models, such as Brock-Shores-Merton model. Volatility measures the standard deviation of a continuously compounded return on the underlying asset. In practice, we often estimate volatility using a historical series of continuously compounded daily returns. We gather a set of daily holdings periods returns and then use equation 5 to convert them into continuously compounded daily returns. We then compute the standard deviation of the continuously compounded daily return and annualize that number using equation 8 by convention. Volatility is stated as an annualized measure. Example 10 illustrates the estimation of volatility for shares of Astra International. Example 10, volatility as used in option pricing model. Suppose you are researching Astra International, Indonesia Stock Exchange, ASII, and are interested in Astra's price action in a week in which international economic news has sufficiently affected the Indonesian stock market. You decide to use volatility as a measure of the variability of Astra shares during the week. Table 7 shows closing prices during the week. Using data in Table 7 to do the following: estimate the volatility of Astra shares, annualized volatility based on 250 days in a year, identify the probability distribution for Astra shares prices if continuously compounded daily returns follow the normal distribution. Solution to 1. First, use equation 5 to calculate the continuously compounded daily returns. Then find their standard deviation in the usual way. In the calculations of sample variance to get sample standard deviation, use the divisor of 1 less than the sample size of this. Yeah, so that's what the calculations look like. The standard deviation of continuously compounded daily returns is 0.021261. Equation 8 states that the standard deviation with a hat, R0T, is an example of a standard deviation of the 1 period continuously compounded return. Thus, the sample deviation refers to 0.021261. We want to analyze, so the horizon T corresponds with 1 year, as the sample standard deviation is in days. We set T to equal the number of trading days in a year, which is 250. Note that the sample mean of this is a possible estimate of the mean, mu, and the continuously compounded 1 period or daily returns. The sample mean can be translated into an estimate of the expected continuously compounded annual return using equation 7. But best 4 observations are as far as too few to estimate the expected returns. The variability in the daily returns overwhelms any information about expected returns in a series this short. Solution to 2. Astra share price should follow a log normal distribution if it continuously compounded daily returns as Astra shares follows the normal distribution. We have shown that the distribution of stock price is log normal given certain assumptions. What are the means, the variance? ST if ST follows the log normal distribution. Earlier in this section, we gave bullet point expression for the mean and variance of log normal random variable, and the bullet point expression of mean sample standard deviation or mean mu or mean variance mu or the sample variance would refer, in the context of this discussion, the mean and variance of T horizon, not the 1 period continuously compounded return, assumed to follow a normal distribution compatible with the horizon of ST related to the use of mean and variance or standard deviation. Earlier in the reading, we used those quantities to construct intervals in which we expect to find a certain percentage of the observations of a normally distributed random variable. those intervals were symmetrical about the mean? And can we state similar symmetric intervals for a log normal random variable? Unfortunately, we cannot, because the log normal distribution is not symmetrical. As we see, it's skewed to the right. It has a longer tail to the right. Such intervals are more complicated than the normal distributions, and we will not discuss the specific this specialist topic here. Finally, we have presented the relationship between the mean and variance, continuously compounded returns associated with different time horizons. See equations 7 and 8, but how the mean and variance of holding period returns are continuously compounded returns related. As analysts would typically think in terms of holding period returns rather than continuously compounded returns. And we may desire to convert means and standard deviation of holding period returns to means and standard deviation of continuously compounded returns for option application. For example, the effects of such conversations and those in which other directions from a continuously compounding to a holding period basis we can use to the expression in Ferguson 1993. The Monte Carlo simulation, we have heard a lot about this. We have even talked about this previously. Okay. With understanding of probability distributions, we are now prepared to learn about computer-based technique in which probability distribution plays an integral role. The technique is called Monte Carlo simulation. Monte Carlo simulation in finance involves the use of computers to represent the operation of complex financial systems. A characteristic feature of Monte Carlo simulation is the generation of a large number of random samples for a specified probability distribution or distributions to represent the role of risk in the system. Monte Carlo simulations have several quite distinct uses. One use is the planning or the Stanford University research Sam Savage. Oh, Savage? Imagine having called Savage. Okay, Sam Savage provided the following neat picture of the row. What is the last thing you do before you climb on the ladder? You shake it. And that is the Monte Carlo simulation. Just as shaking a ladder helps you assess the risk of climbing it, Monte Carlo simulation allows us to experiment with proposed policies before actually implementing it. For example, investment performance can be evaluated with reference to a benchmark or a liability. Defined benefit pension plans often involves assets with reference to plan liabilities. Pension liabilities are a complex random process in the Monte Carlo liability financial planning study. The fluctuation of pension assets and liabilities is simulated over time, given assumptions about how assets are invented, the workforce, and other variables. A key specification in this and all Monte Carlo simulations is the probability distributions of the various sources of risk, including interest rate and security market returns. In this case, the implications of different investment policy decisions on a plan's funded status can be assessed through simulated time. The experiment can be repeated for another set of assumptions. We can view example 11 below as coming under this heading. In that example, market returns series are not long enough to address researchers' questions on stock market timing. So this researchers stimulate market returns to find answers to their question. Monte Carlo simulation is also widely used to develop estimates of VAR. In this application, we simulate the portfolio profits and losses performance for a specific time horizon. Repeated trials within the simulation. Each trial involves a draw of a random observation for a probability distribution produces a frequency distribution for changes in portfolio value. The point that defines the cutoff for the least favorable 5% of simulated changes is an estimated 95% of VAR, for example. In an extremely important use, Monte Carlo simulation is a tool valuing complex securities, particularly some European-style options for which no analytic pricing formula is available for other securities, such as mortgage-backed securities with complex embedded options. Monte Carlo simulation is also an important modeling resource Researchers use Monte Carlo simulation to test their models and tools. How critical is a particular assumption to the performance of a model, because we control the assumption when we do a simulation. We can run the model through a Monte Carlo simulation to examine a model's sensitivity to a change in our assumption. To understand the techniques of Monte Carlo simulation, let us present the process as a series of steps. To illustrate the steps, we take the case of using Monte Carlo simulation to value a type of option for which no analytic pricing formula is available. The Asian call options on a stock. An Asian call option is a European style option with a value at maturity equal to the difference between the stock price at maturity and the average stock price during the life of the option, or $0, whichever is greater. For instance, if the final stock price is 34 with an average value of 31 over the life of the option, the value of the option maturity is 3. The greater of 34 minus 31 is 3. And 0, step 1 through 3 of the process describe specifying the simulation. Step 4 through 7 provide running the simulation, specify the quantities of interest, option value, for example, or the funded status of a pension plan in terms of underlying variability. The underlying variability or variables could be stock price for an equity option, the market value of pension assets, or other variables relating to the pension benefit obligation for a pension plan. Specify the starting value of an underlying variability. To illustrate the steps, we are using the case of valuing an Asian call option on stock. We use CIT to represent the value of the option at maturity T. The subscript I in CIT indicates that CIT is a value resulting from the IF simulation trial. Each simulation trial involves a drawing of a random variable and iteration of step 4. Specify a time grid. Take a horizon in terms of calendar time and split it into a number of subperiods. Say K is total calendar time divided by the number of subperiods. K is the time increment of delta T. Specify distributional assumptions for the risk factor that drives the underlying variables. For example, stock price of an underlying variable for the Asian calls. If we need a model for stock price movement, say we choose the following model for changes in stock price, where ZK stands for standard normal random variable, delta stock price, or change in stock price, equals mu multiplied by prior stock price multiplied by delta T, plus the standard deviation multiplied by prior stock price multiplied by ZK. In the way that we are using the term ZK and is a risk-free factor in the simulation. Through our choice of mu and standard deviation, we control the distribution of stock price. Although this example has one risk factor, a given simulation may have multiple risk factors. Using a computer program or spreadsheet function, draw K random values of each risk factor. In our example, the spreadsheet function would produce a draw of K values for the standard normal variable of ZK, which is Z1, 2, 3, all the way to ZK. Calculate the underlying variable using the random observation generated in step 4 using the above model of stock price dynamics. The result is K observations on changes in stock price. An additional calculation is needed to convert those changes into K stock price. Using initial stock price, which is given, another calculation produces the average stock price during the life of the option. The sum of K stock prices divided by K. Compute the quantities of interest. In our example, the first calculation is the value of an Asian call at maturity, or CIT. A second calculation discounts this terminal value back to its present to get the call value as of today. CI0. We have completed one simulation trial. The subscription I is CI0, stands for the IF simulation trial, and it does in CIT. In the Monte Carlo simulation, a running tabulation is kept of statistics relating to the distribution of the quantities of interest, including their mean value and standard deviation, over the simulation trials to the point. Literally, iteratively go back to step 4 until a specified number of trials I is completed. Finally, produce a statistics for the simulation. The key value for our example is the mean value of CI0 for the total time of simulation trials, the mean value of Monte Carlo estimate of the value of the Asian call. How many simulation trials should be specified? In general, we need to increase the number of trials by a factor of 100 to get each extra digit of accuracy. Depending on the problem, tens of thousands of trials may be needed to obtain accuracy to 2 decimal places as required for option values. For example, conducting a large number of trials is not necessarily a problem given today's computing power. The number of trials needed can be reduced using variance reduction procedures, a topic outside of the scope of this reading. In step 4 of our example, computer function produced a set of random observations on a stated normal random variable. Recall, for a uniform distribution, all possible numbers are equally likely. The term random variable generator refers to a logarithm that produces uniformly distributed random numbers between 0 and 1. In the context of computer simulations, the term random number refers to an observation drawn from a uniform distribution. For other distributions, the term random observation is used in this context. If it is a remarkable fact that random observations from a distribution can be produced using the uniform random variable with endpoints 0 and 1. To see why this is so, consider the inverse transformation method of producing random observations. Suppose we are interested in obtaining random observations for a random variable x with cumulative distribution function f of x. Recall that f of x evaluated at x is a number between 0 and 1. Suppose a random outcome of this random variable is 3.21 and at f of 3.21 equals 25%. Define the inverse of f called f inverse that can do the following. Substitute the probability of 0.25 to the inverse of f and it returns the random outcome of 3.21. In other words, the probability of inverse f is 3.21. What? That doesn't make sense. Probability can't exceed 1. That's kind of weird. I'm not getting this. I'll try to get this later. To generate random observations on x, the step R1, generate a uniform random number R between 1 and 0 or 0 and 1 using the random number generator, and 2, evaluate inverse f of R to obtain random observations on X. Random observation generation is a field of study in itself. And we have briefly discussed the inverse transformation method here just to illustrate a point. As a generalist, you do not need to address the technical details of converting random numbers into random observations. But you do need to know that random observations from any distributions can be generated using a uniform random variable. In example 11 and 12, we give an application of Monte Carlo simulation to a question of great interest to investment practices. The potential gain from market timing. Potential gain from market timing, a Monte Carlo simulation 1. All active investors want to achieve superior performances. One possible source of superior performance is market timing ability. How accurate does an investor need to be as a bull and bear market forecaster for market timing to be profitable? What size gains compared with a buy and hold strategy accrue to a given level of accuracy. Because of the variability in asset returns, a huge amount of return data is needed to find statistically reliable answers to these questions. Cha, Woodward, and Toe thus select the Monte Carlo simulation to address the potential gains from market timing. They were interested in the perspective of a Canadian investor. To understand their study, suppose that at the beginning of a year, an investor predicts that the next year will see either a bull market or a bear market. If the prediction is bull market, the investor puts all her money in stocks and earns the market returns for the year. On the other hand, if her prediction is bear market, the investor holds T-bills or treasury bills and earns the T-bill returns. After the fact, a market is categorized as bull market if the stock market returns RMT minus the T-bill return RFT. Is positive for the year. Otherwise, the market is classed as bear market. The investment results of a market timer can be compared with those of a buy and hold investor. A buy and hold investor earns the market return every year. For Cha et al., one quantity of interest was the gain from the market timing. They defined the quantity as the market timer's average return minus the average return to a buy and hold investor. To simulate market returns, Cha et al. Generated 10,000 random standard normal observations of ZT. At the time of the study, Canadian stocks had a historical mean annual return of 12.95% with a standard deviation of 18.3%. To reflect these parameters, the simulated market return RMT equals to this much. Using a second set of 10,000 random standard normal, that's a lot of adjective. Random standard normal observations, historical return parameters for Canadian T-bills, as well as the historical correlation of T-bills and stock returns, the offers generated 1,000 T-bill returns. An investor can have different skills in forecasting bull and bear markets. Cha et al. Characterize market timers by accuracy in forecasting bull markets and accuracy in forecasting bear markets. For example, bull market forecasting accuracy of 50% means that when the timer forecasts bull markets for the next year, she is right just half of the time, indicating no skill. Suppose an investor has 60% accuracy in forecasting bull markets and 80% accuracy in forecasting bull markets. A 60 to 80 timer, we can simulate how an investor would fare after generating the first observation on RMT subtracted by RFT. We know whether that observation is a bull or bear market. If the observation is bull market, then 0.6 forecast accuracy for bull markets is compared with a random number between 0 and 1. If a random number is less than 0.6, which occurs with a 60% probability, then the market timer is assumed to have correctly predicted bull markets, and her returns for the first observation is the market return. If the random number is greater than 0.6, then the market timer is assumed to have made an error and predicted the bear market. A return for the observations is the risk-free rate. Yeah, there we go. So here's a solution example 2. Okay, let me read this. An analyst chooses the probability distribution of Monte Carlo simulation by contrast historical simulation samples from historical record of returns or other underlying variability to simulate a process. The concept underlying historical simulation, called the back simulation, is the historical record provides the most direct evidence on distribution, and that's the past applications to the future. For example, refer back to step 2 in the outline of Monte Carlo simulation above. Is suppose the time increment is 1 day. Further, suppose we base the simulation on the record of daily stock returns over the last 5 years. In one type of historical simulation, we randomly drew K returns from that record. To generate one simulation trial, we put back the observation into the sample. And in the next trial, we again randomly sampled with replacements. The simulation results directly reflected the frequencies in the data. A drawback of this approach A drawback of this approach is that any risk not represented in the time period selected, for example, a stock market crash, will not be reflected in the simulation. Compared with the Monte Carlo simulation, historical simulation data does not lend itself to what-if analysis. Nevertheless, sin embargo, simulaciones de historia es muy importante para... sorry, that's Spanish. Nevertheless, historical simulation is established alternative simulation methodology. Monte Carlo simulation is a complement to analytical methods, provides only statistical estimates, not exact results. Analytical methods were available, provide more insight into cause and effect relationship. For example, Black-Scholes Merton option pricing models for the value of European call options is an analytical model expressed as a formula. It is a much more efficient model for valuing such a call than is Monte Carlo simulation as an analytical expression. The Black-Scholes Merton model permits the analyst to quickly gauge the sensitivity of call value to changes in current stock price and the other variables that determine call value. In contrast, Monte Carlo simulation do not directly provide such precise insights. However, only some types of options can be priced with analytical expressions as financial product innovation proceed. The field of application for Monte Carlo simulation continues to grow. Summary. In this reading, we have presented the most frequently used probability distribution in investment analysis, a Monte Carlo simulation. A probability distribution specifies the probabilities of the possible outcomes of a random variable. The two basic types of random variables are discrete random variables and continuous random variables. Discrete random variables takes on at most a countable number of possible outcomes that we can list as x1, x2. In contrast, we cannot describe the possible outcomes of continuous random variable z with a list z1, z2, because the outcome z1 plus z2 divided by 2 is not on the list. Not on the list would always be possible. The probability function specifies the probability that a random variable would take on specific value. The probability function is denoted probability of x, or p of x, for a discrete random variable, and f of x for continuous random variables. For any probability functions, p of x must be between 1 and 0. The sum of p of x over all values of x equals 1. The universal set equals 1. The cumulative distribution function, denoted as f of x for both continuous and discrete random variables, gives the probability that the random variable is less than or equal to x. The discrete uniform and the continuous uniform distribution are the distributions of equally likely outcomes. The binomial random variable is defined as the number of success in n Bernoulli trials, where the probability of success p is constant for all trials, and the trials are independent. A Bernoulli trial is an experiment with two outcomes which can represent success or failure, an up move or a down move, or another binary or twofold outcomes. A binomial random variable has an expected value or mean equal to NP and variance equal to NP multiplied by 1 minus P. A binomial tree is the graphical representation of a model of asset price dynamics in which at each period the asset moves up with probability P or down with probability 1 minus P. The binomial tree is a flexible method for modeling asset price movement, and it is widely used in pricing options. The normal distribution is a continuous symmetric probability distribution that is completely described by two parameters. It means mu and its variance is standard deviation square. The univariate distribution specifies the probabilities for a single random variable. A multivariate distribution specifies the probability for a group of related random variables. To specify the normal distribution for a portfolio,
when is composite securities and normally distributed, we need the mean, standard deviation, and all distinct pairwise correlation of the securities. When we have those statistics, we have also specified a multivariate normal distribution for the securities. For a normal random variable, approximately 86% of all possible outcomes are within one standard deviation interval. About the mean, approximately 95 are within 2 standard deviation and interval about the mean, and approximately 99% are within the third or the 3 standard deviation intervals about the mean. Normal random variable x is standardized using expression z equals x minus mu divided by the standard deviation, where mu and standard deviation are the mean and the standard deviation of x. Generally, we use the symbol x bar as an estimate of mu, which is a sample standard deviation. S is an estimated of the standard deviation of in the expression. The standard normal random variable denoted z has a mean equal to 0 and variance equal to 1. All questions about any normal random variable can be answered by referring to the cumulative distribution function of a standard normal random variable denoted as n of x or n of z. Shortfall risk is the risk that portfolio value will fall below some minimum acceptable level over some time horizon. Roy's safety first criterion addresses shortfall risk, asserts that the optimal portfolio is the one that minimizes the probability that portfolio return falls below a threshold level. According to Roy's safety first criterion, if returns are normally distributed, the safety first optimal portfolio P is the one that maximizes the quantity ERP subtracted by RL divided by standard deviation of P, where RL is the minimum acceptable level of return. A random variable follows a log normal distribution if the natural logarithm of the random variable is normally distributed. The log normal distribution is defined in terms of the means and variance and its associated normal distribution. The log normal distribution is bounded below by 0 and skewed to the right. It has a long right tail. The log normal distribution is frequently used to model the probability distribution of asset prices because it is bounded below by 0. Continuous compounding views times as essentially continuous or unbroken discrete compounding views time as advancing in discrete finite intervals. The continuously compounded returns associated with a holding period is the natural log of 1 plus the holding period returns, or equivalently the natural log of ending price over beginning price. If continuously compounded returns are normally distributed, asset prices are logarithmically distributed. The relationship is used to move back and forth between the distributions for return and price. Because the central limit theorem, continuously compounded returns need not be normally distributed for asset prices to be responsibly well described by a log normal distribution. Monte Carlo simulation involves the use of computer to represent the operation of a complex financial system. A characteristic feature of Monte Carlo simulation is the generation of a large number of random samples for specified probability distribution to represent the operation of risk in the system. Filed probability distributions to represent the operation of risk in the system. Monte Carlo simulation is used in planning in financial risks management and in valuing complex securities. Monte Carlo simulation is a complement to analytical methods by providing only statistical estimates, not extra results. Historical simulations is an established alternative to Monte Carlo simulation. That is, one implementation involves repeated samples from the historical data series. Historical simulations is grounded in in actual data because but can reflect only risk represented in sample historical data. Compared with Monte Carlo simulation, historical solutions does not lend itself to what-ifs analysis. Okay. So this is, I think, part 3 of reading 10 of CFA level 1. I'll continue the reading of part 4, I do think. Oh no, I finished this part. So so we finished our reading 10 then. So I hope reading 10 has been helpful, and I hope to see you guys in reading 11. We'll be going over sampling and estimation. It's going to be an exciting chapter. I hope to see you guys there, and take it easy. Goodbye.